Will Netflix stock go up? That's the question. For someone who is looking to invest in Netflix, maybe you've heard a lot about Netflix and then you are thinking, okay, I want to give it a try. Let me see if I can quickly put some funds in. Now, you need to ask yourself whether Netflix is actually okay or whether Netflix will go up from where it is right now. Why should you ask that question? Because Netflix stock is selling for as high as 566.55. So you need to ask yourself whether this price you're paying for Netflix is cheap or expensive. It's important you do that because Netflix stock has rallied so high. In the last 5 years, look at it, it has done 51%. Last 1 year, 72%. 6 months, 39%. In 1 month, it's down by 9.7%. And then if you look at the chart of Netflix, you see how Netflix stock has rallied from a low of $2 to reach a high of almost 685. And then before it, we saw a massive dip, and then you're seeing a brief recovery. So the question is, if I buy Netflix right now, am I buying at a cheap price or am I buying at a very high price? Now we know Netflix, we know what it does. Now Netflix recently released its financials. You can see right here, Netflix blew past earnings estimate as subscriber jumped 16%. Netflix beat quarterly earnings and revenue estimates. The company said subscribers jumped 16% from year earlier period, but added it will no longer report paid membership starting next year, meaning that Netflix will no longer report subscribers numbers going forward. So Netflix has focused more on growing profits rather than boosting subscribers. Now, what is the business of Netflix? What exactly do they do? So let's look at Netflix itself. Netflix is a video on demand streaming service platform now that distributes, acquires original movies and film shows. It actually charges users per month. So, and if you're familiar with Netflix, you know how it is. It's not a free platform. You have to pay either with your card or PayPal, depending on the region that you are in, and then to access movies on the platform. That's what Netflix is all about. If I go online right here and I search Netflix, so we see it's a media company. This is Netflix platform. So you can see that you have access to a lot of movies. You can see unlimited TV, movies, and more. That is Netflix for you. So question is, I want to buy their shares. Am I going to pay high? Am I paying high for this company share? That is what I will attempt to resolve in this particular video course. I'm going to show you how to check for Netflix, how to check whether you are the share price is going to go up or whether you should stay out of Netflix completely. Now, one of the things you need to check is whether Netflix is a quality stock. When you're attempting to buy a stock for investment, one question you must answer is, are you buying to a quality company? How do you know a quality company? I'll discuss that shortly. So let's look at the performance of Netflix. I've discussed it, how Netflix has done extremely well, 51%, 72, 39. Now, the best period has always been in the last 1 year, it has done 72% and 6 months. Now, when you want to invest in a stock like Netflix, you need to ask yourself, is this stock a quality stock? When you answer that question, you are able to tell whether the stock will go up or not. Why? Because a quality stock will always do well in the markets. Even if there's market crash, even if there's market dump, even if there's dip, quality stocks are among the first to recover. Why? Because these are stocks that have record of good sales, earnings, profits. Sure, when you look at the fundamentals, they are strong, and that's even an opportunity for you to buy more on dip. So these are the questions we're going to answer. So if you want to know whether a stock will go up in the future or not, then you need to check for the quality of the company, because a lousy company will always dip. If you buy into a lousy company, you are actually setting yourself up for a huge loss. This kind of stock may not recover. So the big question is Netflix a quality stock? Now, I have also actually make my video course available for you at 25% discount, meaning that if you want to learn how to analyze a stock for investment, you can see right here, I have this course up for you, 25% discount going, and that is when you apply the discount code 25A right here. So if you want to learn how to screen Do you understand? So this company that analyze Netflix, how do you find them in the market? How do you know whether they stop? Because you can't be going through 10,000 companies in the US market. So you need to find a way to be able to screen for stocks that meet certain checklists. That will then give you opportunity or access to good companies that will meet your criteria, because you can't be picking stocks randomly or assume that every company that comes to your head are a great company because you know their name. No, there are certain metrics you need to put into check to ensure that these companies are great company. There is the good company, there is the best company, there is also a great company. Make sure you are only buying into great companies in the market. So that's what this video course would. So it's actually part of this video course, some of the content of this video course that I'm sharing right here. So you can imagine that if I'm giving you this kind of value on how to analyze stock, on how to check whether Netflix stock will go up, you can imagine the numerous value or content that will give you that will help you analyze stock going forward. So let's look at this particular slide. I called it from this particular video course. How do you analyze a stock? So here, these are the checklists. Now, is Netflix a quality stock? I'm not going to tell you yes because I know Netflix or because I use them, because I think everybody's using their product. No, I would not tell you no because I think that Netflix is high, maybe because I feel the share price is around 566. And I think, oh, it's quite expensive. No. First thing is, let's use this particular checklist to confirm whether Netflix is a quality stock or not. And then look at the checklist. First, we're asking, is Netflix recording consistent growth in revenue, profit, and cash flow? That's the question. So let's quickly check Netflix financials on Yahoo Finance. I like to use Yahoo Finance for my analysis. It makes my job easier. So we'll go to Yahoo Finance. We'll pull out under income statement. So the question now is Netflix posting consistent growth in revenue, profit, and cash flow? This is the first checklist because every company's growth or every company's financial starts with revenue or sales. If a company is not making money, why is it in business? So I'm not even going to waste my time doing further analysis if it fails this first checklist. So here, look at Netflix revenue from 2020 to date, 24.9, 29.6, 31, and 33. Check. Meaning revenue is okay. Consistent growth in revenue. Let's look at profit of Netflix. 2.7, 5.1, 4.9, a slight dip, and then 5.4 and 5.4. This is also okay. Now you might ask me, okay, is this not a dip from 5.1 down to 4.4? Now, in my video course, I shared an insight on how to know whether a company share price dip is temporary or permanent, and then how to know whether, irrespective of that dip, the company is still on track. I talked about that because while looking at the growth in each year, there are times you will see a dip, but it's not all the dip that you're considering as a no. There are dip that are temporary, and then I will show you how to check whether a dip is temporary or not. That's why you need to get the video course. Now, this is also checked. Let's look at the cash flow of Netflix. I mean the free cash flow of Netflix. From 1.9, you can see right here, declared a loss. This is negative free cash flow. And then 1.6, and suddenly we saw a huge spike to 6.9 billion. This is also okay. So it means that under consistent growth in revenue, profit, and cash flow, is a yes for me on Netflix. So let's mark this yes. Fine. Now, when we're done with this stage, we move to the next one. Now, is Netflix debt conservative? Are they maintaining conservative debt? This is very important. I don't want to buy into a stock that is that may not be a going concern. I don't want to buy into a stock that its existence is being threatened because it's owing, because it's exposed to debt or interest rate risk. So I check for low debt to equity. So let's go back to Netflix financials. So here we look at the balance sheet of Netflix stock. So here I'm looking at the total equity against the debt of Netflix. What is total debt? You can see from here, all in thousand is 14.5 billion. 14.5 billion. That is it here. What's total equity of Netflix? Is around 20.5. So when you do 14.5 divided by 20.5, so debt to equity is less than 1. 70, which is very, very okay. Now, this debt to equity helps you check the capital structure of a company. And I like to buy into a company that is largely funded by shareholders' equity and not debt. It looks like debt is not good, but then a company has to be conservative in its debt exposure. Now, impressive interest coverage. This is also very important. Now, when the companies borrow, I want to see if the company is generating enough earnings from operation to cover up for interest obligations. That means without having to borrow, can this company earnings from its operating activities be able to cover up its interest obligation? So that's also important that we'll look at. So how do you find that? You go to your income statement. You see how I find everything on one spot. Yahoo Finance will give you everything you want. So here we're looking at interest before interest and tax. Earnings before interest and tax, 21.5 against interest expenses of 748. So if we do 748.5 as against this number, 21.5, you can see how huge this figure is. Can you see here? So that's like 748 against 21.5. So 21.5, 748. You can see that's 42 times. That means Netflix earnings can actually cover the interest expenses 42 times, which is very, very okay. Now, the idea is that your interest coverage must be above 1, and the higher, the better, meaning the company is generating enough revenue. You can see Netflix have passed the first checklist. Conservative debt, yes. Now, let's look at the profitability of Netflix. First one is profit margin. You know, one of the advantages of looking at profit margin is that it helps you check whether a company is enjoying competitive advantage. Because if a company is able to raise its price over time, will it lose customer? If it loses customer, then it's not going to make much sales. But if a company raises its price and it doesn't lose much customer, it means that profit will be a lot more higher. And if profit is higher, then profit margin will also follow suit. So look at net profit of Netflix, 5.4 billion compared to 33.7 billion. So 5.4 billion divided by 33.7, you can see a 16%. 16%. Now, by standard, a company must maintain a net profit above 10%. So it's a yes for me on Netflix stock. It's a yes. It's a yes for me on Netflix stock. Now, return on equity is also important. Now, under return on equity, we're looking at how much profit can a company generate on the shareholders' fund. Do you understand? It also gives an idea of how the company is utilizing shareholders' fund. Now, 5.4, which is the net income, 5.4, we're looking at 5.4 against equity. 5.4 against equity. What is equity? Equity is 20.5. 5.4 against 20.5. 5.4 divided by 20.5. That's like 26%. So return on equity of 26% is extremely okay. It's not bad. It's not bad because by standard, return on equity should be above 15%. Sometimes it depends on the industry, but I think return on equity above 15% is perfect. So Netflix passed the first one, second one, third one, fourth one, fifth one. Now, what is the liquidity ratio of Netflix? Let's look at liquidity. Now, the liquidity helps you to look at the ability of that company to settle its short-term obligations without having to borrow. You can see Netflix is not exposed to debt like that. So let's look at the liquidity position. First is current ratio. Current ratio, here we're looking at the current assets divided by current liability. Current asset over current liability. So total assets, current asset is 9.9. Then total liability, current liability is 8.8. So 9.9 divided by 8.8. That's 1.12, which is also okay. Now, what is current ratio? You're looking at the ability of that company to settle its current obligations without having to borrow. Now, look at Netflix financials. Current asset, they are 9.9. These are assets you can quickly convert to cash. One of it, 7.9 is already cash. Receivable is already 1.8. Now, if you want to quickly pay off this obligation, current liability, you can see here, these guys can pay off that amount, this particular 8.8 with 9.9 without having to borrow. And that's a good sign. When a company can pay up in debt without having to borrow, that's actually one great sign of liquidity. Then debt servicing ratio. Imagine after passing all these basic checklist, and then we are here to look at debt servicing ratio. Debt servicing ratio, here we're looking at ability of that company to settle its interest obligation with cash flow up from operation. If the company is generating cash or is not able to generate enough cash to pay off its debt, what does that mean? It's not a good thing. So here, interest obligation is 7.2 billion. Sorry, operating cash flow is 7.2 billion. Operating cash flow 7.2. That's cash from operation. And then look at it against interest expenses. Interest expenses is, you can see here, 748 million. 7 billion against 748 million. That means it's way higher. That means the company can actually settle its interest obligations with the cash flow from operation. So what does this tell us right now? It means that Netflix is a quality stock. Can you see that? Netflix is a quality stock. This is what we're looking for. We're looking for a stock that passes all these checklists. Netflix is a quality stock. Now, I said earlier, if a stock is a quality stock, there is higher chance that these guys will continue to rally higher. Because when you look at consistent growth in revenue, profit, and cash flow, if this company maintains that growth trend, it means in the next 5 to 10 years, this guy's share price will follow because they will continue to report higher number. And people like to buy into a company that their growth is steadfast. So this is what Netflix has shown to us. Now, the final question is, at 566 price, is Netflix stock fairly valued? Is it undervalued or is it overvalued? That's what we attempt to answer under this section. Because if you want to look at the share price that will go up, first we want to look at the company. Is it a quality company? Yes. Second, am I buying the share price at the higher end? Am I overpaying for that share price? I don't want to pay at an amount that is far more than the value of the company. I want to pay an amount that is far lower. I want to pick the company at a bargain price. When you pick a company stock at a bargain price, there is higher tendency that the company share price will meet up and will continue to appreciate. Why? Because when others discover the fact that this company share price is undervalued and the fact that it's actually a quality stock, then there is higher chance that this stock will go up. So here I'm going to launch my fair value calculator. This is my fair value calculator. I use this to analyze company stock. So this is my fair value calculator. I use it to analyze company stock. So which stock are we going to look at right now? Netflix. So what the symbol of Netflix is NFLX. NFLX. Yes. So when you impute the symbol of Netflix right here, the system will automatically pick the price. You can see 568, 568. This Excel sheet is already connected to the market. So let's plug in all the numbers. First one is the free cash flow. What is the free cash flow of Netflix right now? What's the free cash flow of Netflix right now? Now, 6,925,749. 6,925,749,123. So this is the free cash flow of Netflix. What is the projected growth rate of Netflix? Now, all these that I'm showing you right here, if you get this course, I took my time to explain what each of the metrics are. So that way you will know where to find them and how to get them and what they mean. So let's look at the projected growth rate of Netflix. If you go to analysis, right here, analysts are projecting an average. You can see 27.67 growth, 27%. So let's go with 27% in the next 5 years. You can see here 27% in the next 5 years. So in the next 5 years, 27%, which means in 6 to 10 years, that number might probably dip. Did you see that? So we're not assuming that Netflix will continue to grow by 27% forever. It will get to 67 years, that growth number might stall. That's why we have to reduce it to 13%. We have a terminal growth rate intact. We have the discount rate intact. Now, what is the share outstanding? What is Netflix share outstanding? I'll go to statistics. Now, share outstanding is 430.9 million. 430.9 million. So this is the share outstanding of Netflix. What is the debt level of Netflix? What is the debt level? Total debt is 16.6 billion. Debt level 16.6 billion. You can see here 16.6 billion. And then what is the total cash of Netflix? Total cash is what? 7.05 billion. You can see here 7.05 billion. 7.05 billion. 705 can see here 7.05 billion. Now, having entered all these key numbers right here, what is the fair value of Netflix? We've entered the free cash flow, we've entered the projected growth rates, terminal rates, we have the share outstanding, debt level, the total cash and cash equivalent of Netflix. So here we want to ascertain the fair value of Netflix. So based on what we have entered, Netflix should be fairly valued at 1,212. Can you see right now? Netflix should be fairly valued at $1,212 in the future. That's the future. That's the future value. That's the fair value of Netflix stock. So if Netflix stock is going to be fairly valued at 1,002, then it means that at the current price of 568, Netflix is 113% undervalued. So that's it. Now let's try to be fair. Let's reduce this 27% to 20%. So let's assume that Netflix will start growing by 20% in the next 5 years, and then in 6 to 10 years to reduce to 10%. It's still undervalued at 800. And then even if I come down to use a modest growth figure of 15%, 15%, meaning in the next 5 years, Netflix will grow by 15%. Netflix should be fairly valued at 597. Do you understand? Which is a bit higher than the 568. So, but here, I think 20% is fair. So that means Netflix should be selling for not less than $800 right now. That's the fair value of Netflix. So meaning that Netflix is 42% undervalued compared to the current market price. So if you come back to Netflix chart, it means that at the current price of 567, Netflix is undervalued. Netflix is undervalued. So you should be looking to buy Netflix on dip. So if Netflix dips, buy more. If it dips, buy more. Because if you hold Netflix for a long time, the share price will appreciate. Why? Because number one, Netflix is a quality stock, haven't met all this checklist of a quality stock. And number two, Netflix is also undervalued at 42% by using a modest growth rate of 20% in the next 5 years. So that is how to check. So that will help you answer the question on whether Netflix stock will go up or not. So when you want to find a stock that will go up, do these two things. One, carry out fundamental analysis of the stock to check the health of that company, because a quality stock will always go up. Number two is that look at the fair value of that company. Now, if a company does not have good fundamentals, dump it and go. You don't even need to carry out fair value analysis. So if you look at this, I don't carry out fair value analysis on a stock, except when I have looked at the fundamentals, except it pass my quality checklist. If it doesn't pass my quality checklist, it's a no-no for me. I don't want to gamble. Why? Because fair value calculation is largely subjective. It's projection. We call it projection. It's not an accurate prediction. It's a forecast. So the only thing that would help you improve confidence on whatever you are projecting is when the company has proven to be a quality company, consistent growth in revenue, lower debt, impressive interest rate coverage, higher net. Do you understand? All these things, these are the things that will give you confidence to continually hold the company in stock. So if you are asking whether Netflix is a quality company, I hope this video will help you answer that question. Now, if this video makes sense to you and you want to get notification on more videos I post, please hit the subscription button or turn on notification bell, so that when I release new videos, you get access to notification, or you get notified on the real time before others. Everything I've shared right here in the video, they are just a part of what you will learn on how to pick great companies. So the question is Netflix a great company? Yes, not because I like Netflix or we use Netflix, but because we have carried out a fundamental check on Netflix and also a fair value calculation, and both of them are telling me that Netflix has the potential of rally higher. So that is all you should know when it comes to picking a great company. And I hope I've been able to share insights on how to trade or how to invest in Netflix stock. Like I said, turn on notification bell and hit subscription button, because I'll be posting more videos on different US companies, and then we look at their fair value calculation and then look at their health check on and know whether it's actually a stock you want to buy or not.